Welcome to Tradiers, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. This is our special Markets in Turmoil episode. Yes, that is making fun of the TMZ of financial networks that think every couple percentage points means that burning timbers are falling from the ceiling. Right now, it does kind of feel like burning timbers are falling from the ceiling too. But every time they flash that Markets in Turmoil graphic, you're supposed to buy, I think. Robert, do you think this is the is this the beginning of a big, huge move lower?
In a couple of days, if you take a step back and look at like a chart of the NASDAQ, for example, you'll see a new all-time high, then a 3%-ish drop, right? 2 and change. When you look at the overall level 5 years from now, this, I don't believe, will look like anything, because all this is the Fed, I think, adjusting to where the data actually has been lately. They're still in a rate cut cycle. Whether they're going to actually continue on that rate cut cycle or not, I probably doubt it, to be honest, as we get into the new year. But they went from pricing in like 225 basis points of cuts through 2025 to a total of now what?
Like 40.
100?
No, in 2025, between now and 2020, then to 25, like 40 basis
from their first rate cut to now.
Oh, yeah, 125,
somewhere in that range.
Yeah, it's crazy.
Well, it's not that crazy where the NASDAQ is based on that.
Yeah, so they have to adjust if the Fed is not going to lower rates like they anticipated that they were. Okay,
yeah, this is one of those things that, just real quick, this is one of those times that, like, you and I had been on the trading floor for years and worked in different levels in the industry, and I'd have friends say to me, markets are crazy today, huh? I'm like, well, the markets dropped 2%, which happens all the freaking time.
Yeah, no doubt about it. So anyway, one thing I always say, and I'm going to say it again, I don't care if you're bored with my same old lines. Bobby and I have been in media for 25 years. You guys know us. You know, sometimes we're right, sometimes we're wrong. You might think our opinions are bullshit, but one thing you cannot argue is that we get fantastic guests. I don't know why they say they say yes, but they do say yes. And this is no exception. We're bringing on Jim Bianco, president of Bianco Research. Let's bring him in. James, first of all, something far more important than any market talk. Okay, far more. First, there's 2 questions I'm going to have to ask you. One, how do you pronounce that word on Bobby's shirt? I mean, I know he's right, but colloquially, I think it's changed, and there are several different things that are right. But then the second one is going to be if you're planning on doing Feast of the Seven Fishes on Christmas Eve. Let's go the first one first. How do you pronounce that word?
Gnocchi.
Okay, so that's how I pronounce it. But
although I've heard it gnocchi too.
He puts the Y in there a little bit, gnocchi, right?
Yeah.
So, which I'm sure is probably correct. Like we were just saying, my name is actually Iuorio, but we don't say that in America. We say Iuorio. We make it easier on people. But Bobby's right. It should be gnocchi. So any of you people who are trying to be more Dago out there, which I'm sure all of you are, right?
The only people I comment to say it correctly is guys with vowels at the end of their last name. I won't ask like a Grabowski to say it correctly.
Yeah,
any more than a Grabowski would ask me to say pierogi correctly in case I'm saying it wrong.
By the way, my assistant she's from Poland, and it's always like she's when she's going back to Poland, everybody at the desk will almost in unison say they need help changing light bulbs or something like that. She actually thinks it's funny, which is good. Now, do you guys do Feast of Seven Fishes, Jim? Did you ever in your life?
Yes, and we're not doing it this year. Just couldn't get it together.
First year you're not doing it?
No, we've kind of off and on for the last several years, but not this year.
Gotcha. So if you're anywhere,
it all depends on effort. It kind of comes down to effort.
Yeah, if either of you are anywhere near Arlington Heights, we are having a big ass ripper Feast of Seven Fishes. We haven't done it in many years, but we were inspired by the movie of the same name that came out about 4 years ago. I'm making 2 fishes. I'm smoking salmon and I'm making a shrimp scampi and a garlic butter. So you guys, both of you are welcome, and I'm not even joking. Yeah.
Well, the movie that you referenced, Jimmy, I watched a little bit of it last night, and you said it reminds me of the Iuorio house in the 70s. It reminds me of my mom's last year, and it reminds me of my. But this is the funny part. Like, my mom does all the cooking. She's 82. She's doing all the cooking again. So it's limited in terms of how much time, how many more years this is going to be done.
Yeah.
Just because, 5 of the 7 fishes are in the zuppa de pêche that she makes.
That's cheating.
So my wife is actually
my favorite part of the whole movie is when the kid, the main, he's bringing the girl, the Medigone girl, into the Feast of Seven Fishes, and she's like, and you have to have 7 fishes, and he's like, I don't know, we're probably breaking some rules. Nobody really counts, and that is exactly describes my family too.
Yeah.
Mm-hmm.
But anyway, let's read Widge first. Just wanted to thank you for having Mr. Bianco on. Been looking forward to his next appearance to discuss all the policy pipeline consequences, which we're going to do right now because we just finished Dago Talk. And I'm trying to watch quietly. You cannot watch quietly, Widge. You are going to make 3 different comments, which, by the way, we love your comments because you're a smart guy. Yeah. So, Jim, he eased today. Surprise, surprise. Why is he easing? Do you think it's the right move? Or are they in the midst of a massive policy mistake?
I'll take the last one last. Yes, they are in the midst of a massive policy mistake. And the market reaction is that they are in the midst of a massive policy mistake. So let's talk about what that policy mistake is. Every time we have a financial crisis or we have a recession, the economy changes. Now, change is not worse. It changes. It changed in 2020. Coming out of 2020, the bond bull market ended because the inflation cycle turned. We are now in an era of higher inflation. This whole, and Powell, I had been railing against him for 2 years because he'd go to these pressers like he had today and he'd say, the economy's broadly normalizing. The economy's getting back to a pre-pandemic level, suggesting that we're still in the same cycle we were in 2019. We are not. This is a newer cycle. This is a cycle of stickier inflation. And what we're seeing with the inflation data is, look, a year ago, the inflation data was much lower than it is right now. And it looks like it's turning higher. The Fed cut rates today, largely because they boxed themselves in. They suggested they were going to cut rates. And then they went into their quiet period. We got the payroll report. We got the CPI. And the best description of that was they weren't strong enough to stop the Fed from cutting rates. And so they kind of had to follow through on it. And then at the presser today, as Powell kept trying to explain that we increased our inflation forecast for 25, we pushed out that we won't get to 2% inflation until 2027, 6 years after we said transitory now. And then he went on to say, but we should continue to be cutting rates in 2025. That did not sit well with the market. The market is thinking we've got an inflation problem and you're trying to ease. Worse is the politics of it. I think it needs to be said that he might be really terrified of this policy mistake because the correct policy might be to raise rates in 25. If this inflation data continues to stay sticky, Donald Trump will go, and I'm going to use some technical economic language, he will go apeshit on Powell. He attempts to raise, cutting rates into the election, and then has to raise rates after he becomes president, even if it's justified. Powell set the stage with that disastrous 50 basis point cut in September. That was a gigantic mistake at this point because it set him up for this. And now the markets are starting to realize that maybe there's going to be more inflation than we think. The Fed is not going to respond to inflation. And now we're going to have to start to deal with the idea that we're going to have much higher interest rates.
So my opinion is that 2025 could be somewhat of a shit show. If revenues completely collapse because of immediate near-term tax breaks or tax cuts, which I think should happen, we're going to run a $3 trillion deficit instead of a $2 trillion deficit. And the supply side solutions that would push down inflation usually take longer to feel them. I think 2026 might be a great year, but I think 2024 could be somewhat of a shit show. Do you agree? I mean, 2025.
Oh, yeah, I think it could be. And I'll throw in one other thing, too, to use that other technical term, shit show.
Yeah.
Look at what's happening to the German economy. It is, for all intents and purposes, in recession, and it is in a bad, very, very bad place right now. The Japanese economy is struggling to get back on its feet. It's not in a good place. And the Chinese economy might be the worst of all of them. Those are 3 of the 4 industrial powers in the world. The 4th is the U.S. And the U.S. seems to have a fairly decent economy with an inflation problem. UK's got an inflation problem as well too. That is problematic, I think, in an era when we can't grow on our own. Look, the S&P, 50% of the revenues of the S&P companies come from overseas. And if everything that is not US is in a bad place, did Justin Trudeau just resign in the last 10 minutes, or will he resign before the end of this call here? And we're going to have no government in Canada as well too. It's a problem for the rest of the world, is also going to be something that could drag us down as well. And that's got to be very concerning right now.
Well, first of all, I'm not worried about Canada because they're going to be the 51st state in the union, so I'm not worried about them at all. I want to address some comments in here, and then I want to go to a question that I promised I would ask. First, Chris is thankful that Jim Bianco is on the show too. We want to give you your due here, Jim Bianco.
Not here we go.
And then we have a couple of comments I wanted to point out for a specific reason. ESK says, get into it, right? My bags are getting FAs. I don't know what that means. And you're talking about pasta. Full Value says Jim doesn't want to chat spaghetti. So we got that one too. Full Value, it's not spaghetti, it's gnocchi.
Right.
And then the last one, MAAI says, as an Italian, I love that shirt. If you want to get this, it's on Hardcore Italian. 15% off if you use the code FU, just so you know. But passing through all of that, Edward McKernan, yeah, that's right.
My buddy, from college.
You guys went to college together, and he asked a question early on Twitter, which I recommend you guys doing a lot. If you don't follow me or Jim Iuorio, we get questions early from some of our followers. He said, here, where is it? First of all, he said, I'm still waiting on a housing recovery that the Fed's responsible for killing. And when I told him to show up and ask questions, I'm not sure if he's here. He said, Jim Bianco and I went to Marquette together. He graduated in 84. We're on the same dorm floor sophomore year. He went business and I was engineering. Smart guy, but
here comes the 16th floor of Towers comment. Go ahead.
Yeah. Last summer, I think he was guessing we would have a 5% 10-year treasury by now. I'm a semiconductor vet and lean towards lower rates because of Moore's law tech deflation. Okay, so based on that, we have to look at the 10-year where it is around now, which is quite a bit closer to your prediction than when Ed wrote that question. So what say you, Jim?
So first of all, the 10-year's already been at 5%. It hit 503 in October of 2023. So what I was arguing, just so everybody understands where I was coming from, is I said October 2023 is not the high of the cycle, that there will be a higher high in the cycle. So we'll have to go through 5. Now, it's taken longer than I thought. I still think that interest rates are in a trajectory. It gets back to my earlier comment. The 40-year bull market in bonds ended in 2020. We are in year 5 of a multi-year rise in interest rates. And I think that we're going to continue to see interest rates move higher from here. Let me say something about that real quick before I address the rest of the question. When I say that, everybody gulps because we're all used to the 2010 to 2020 period. The perfect interest rate is 0. The higher they go, the worse it means. No, the perfect interest rate is whatever your economy is growing at. If you have a nominal growth economy, nominal is real growth plus GDP, at around 6%, which is what the US is right now, then your interest rate should be 6%. If you're Argentina before Milei and you had 100% growth, of course, 110 of that was inflation and minus 10 of that was real growth. So then your interest rate should be 100. If you were Japan before COVID and you couldn't get your nominal GDP above 0, then your nominal rate should be 0. So the appropriate rate, the rate that will make the economy grow the fastest, is higher from here because we have a higher nominal growth economy. I think rates need to go up. If they go down, they create more malinvestment, they create more inflation. Now, to Ed's comment about Moore's law, yeah, you got tech inflation, deflation. 75% is CPI services. It's wages. And the other 25% is goods, and most of those goods are not tech goods. So accept it. Moore's law, you've got tech deflation. You could still have an inflation problem on top of that, because that's not what drives inflation. That's what drives lower tech prices. And lower tech prices are not enough to describe what is inflation. The cycle has changed, I think, and it's very difficult because we all want to go back to 2010 to 2020 when we had one handle on inflation. We could have zero interest rates and we could not get inflation to go up. Now we've got inflation and we might need 5 or 6% handles on inflation to bring it down. The problem is, like I said, the Fed has lowered rates right before Trump has come into office. And if we have an inflation problem, they have to respond to it. Politically, it is going to be ugly for the Fed in 2025.
So okay, the inflation thing is interesting because when you look back to the early 80s, everyone gives Paul Volcker credit. They give Ronald Reagan credit. I give the internet credit. Okay, I think the internet was one of the most deflationary pieces of technology ever. And I know what you guys just talked about, Moore's law. You're talking about the price of technology coming down. I'm talking about the disinflationary implications that technology has on our economy. Now, the question I ask is AI something that in the next 2 years that is going to increase productivity enough that it is going to be a significant factor in keeping inflation from really skyrocketing? And I think you are talking about 3% inflation. You're not talking about 5% inflation, correct?
Correct.
So I guess it's a
Correct.
two-part question. And does AI figure into your calculus for keeping it lower?
Sure.
Yeah.
Sure. And let me put that number on it. The Fed is talking about that they want to get inflation back to 2%. I think it's going to have a 3 handle on it, somewhere between 3 and 4. And it's not that far away now. It's about 2.8 anyway right now. And it seems to be drifting higher. If that's the case, where should interest rates be in that environment? Well, 3% inflation plus what the Fed likes to call R-star means that that interest rates should be some level above the inflation rate. They say 50 basis points, but more and more it's looking like it should be 100. That means that the natural Fed rate, the neutral Fed rate, should be somewhere near 4%. They're 4.25 right now. They're there right now. Now, if that's where the neutral rate should be and the yield curve returns positive, that means the 2-year note should be probably around 450. That means that the 10-year note should probably be in the mid 5s. That means corporate rates should be approaching 6. And that, again, is normal. That is what we need to have optimal growth in the economy. We have got this broken mentality that, no, we need negative interest rates. We need zero interest rates. We need, to just get all free money all the time. The problem with all free money all the time is you create malinvestment and you create distortions, not only in financial markets. You see it with crypto, you're seeing it with a lot of tech stocks, but you also create distortions in economies with cheap money, and that's inflation. So I think that we have to understand that old cycle is turned. We're in a different cycle right now.
Guys, if I pronounce anyone's name incorrectly, my apologies. I'll do the best I can. If I miss a comment, keep putting it in, and I'll get to it at one point.
Can I throw in another comment real quick before you jump in on and mispronounce the name? About AI in the 2 years in with AI. Yeah, I think AI is coming down the pike. And I think that it's going to be very significant. But I'll use my example. Look, I think AI could be more significant than the internet itself. But I'll use my example of Amazon. In 1999, Time Magazine's Man of the Year was Jeff Bezos because of Amazon. And in 2012, Amazon's stock was lower than it was in 1999. For the next 12 or 13 years, it went nowhere. Why? Because they gave a Man of the Year because online retailing was coming, and they were correct, except it took 15 more years than they thought. Do I think it's going to take 15 more years than we think with AI? No, but I don't think it's coming in 2 years. I mean, it's coming in some applications in 2 years. But is it going to change the very nature of everybody's job in Topeka, Kansas, all the way to New York City, AI? It's not coming that fast. Now that I've said that, I want to make one other comment about AI. Mark Rowan, the head of Apollo, spoke at a Goldman Sachs conference last week. And he brought up the point, which has been very true. Jianqun Hong, who's the head of NVIDIA, which is the second largest market cap company. They're in a running battle with Apple as to whether or not they're the largest. And their stock is up hundreds of percent this year. Everybody listening to me, if you own anything in the stock market, we are all joined at the hip at NVIDIA. It is the single most important stock. It is more important than Elon Musk. It is more important than Donald Trump for the returns of 25. That NVIDIA is going to determine where the S&P goes, where your portfolio goes, where the general stock market goes right now. It is that big, it is that volatile, and it is that important. And what is going to drive that is going to be the expectations on AI. We better have AI come in 2 years, or NVIDIA is going to be a disappointment. And then everybody is going to feel it because it is too important a stock. And it has been the primary driver of the Mag 7, of the entire stock market over the last 18 months. And I think it will continue to be.
All right, so real quick, I want to put Ed's comment up one more time because I think you had answered it already. Ed Mahaffey, is that right? Said, what is a terminal rate for the 10-year? Still think 5.5. And I pretty much think you answered that in your last thing. But I want to ask you something real quick.
Let me rephrase that. Let me just reiterate that again.
Please.
Three inflation, roughly 4 funds rate, roughly 4.5 on the 2-year note, 5.5 on the 10-year note. That's normal. That's neutral. If the inflation problem is bigger than we think, you have to go above those levels in order to rein it in. And I think that if we get all of those levels, why does everybody ask me this? Because they think everything's going to crash if we get those levels. No, that is the normal level. Those are the levels that this economy needs. Anything below that creates distortions, creates bubbles, creates problems. Look at Fartcoin. It just went over $1 as we've been talking right now.
Never thought we'd utter that phrase on our show. Look at Fartcoin. Okay.
Right. It's $1 billion coin that didn't exist 6-7 weeks ago right now. This is all because we all want zero interest rates. We all want free money. We all want to foster a malinvesting in bubble. That's why I'm saying that rates have to go up. And I'm saying it's a good thing if they go up. It's not a bad thing. And the sooner they get there, the lower the probability that we have to go even higher than that. Jamie Dimon's been saying exactly the same thing. He's saying, look, if we don't rein in, if we don't get inflation, if we don't get interest rates, to like 5.5% in the 10-year note, then we might have to go to 6 or 7 to get inflation reined in. That would be a problem if we have to wind up doing something like that.
So I want to ask you about something, and then I'm going to go back to viewer questions. But when you look at, first of all, you're referencing CPI a lot. The Fed references PCE a lot. I personally think that's deliberate because it's historically lower. I think probably when they're trying to generate inflation, they reference CPI, but I don't have any data on that. But does PPI get ignored, and do wages get ignored by the Fed and by sort of the financial media? Because by my math, and you could disagree with my math if you want, PPI is running at about 4.5% annualized, and wages still 4% plus when you look at it on an annualized basis. And to me, those two numbers are not consistent with 2% inflation, no matter which metric you use to measure it.
I agree. Just to put that number in perspective, wages can grow above the inflation rate, but maybe by 0.5%. In other words, everybody can't get a 4% raise and have prices go up 2% at the store. You will accumulate more real wealth to the point where you'll say, I'll bid on some of the things that I want because I've got extra money, and that drives up the prices. Wages can grow 0.5% or 1/3% above the inflation rate, but not 2 or 3%. I mean, they can for a year or two, but not consistently, because otherwise you trade too much wealth. You have a demand pull on inflation higher. So the wage numbers do get focus, a lot of focus at the Fed. The problem is they can't talk about it. The reason they can't talk about it is the Federal Reserve Chairman never wants to be in the position to say everybody's getting a raise and that's a bad thing, and I have to do something about everybody getting a raise. But essentially, that's what they're trying to do, is that they're trying to say, look, if we're going to return to a 2% inflation world, then we need to return to about a 2.5% wage world, and we need to return to about a 2% PPI world. Now, why doesn't PPI get as much attention? Because the Fed doesn't target PPI. They target inflation, and they target PCE inflation, to be specific. So PPI becomes an input, wages become an input into their inflation target. And we're so financialized that the level of borrowing costs is what really dominates the thinking in the marketplace right now.
So I just want to go real quick to a viewer comment / question before I let Jim take over again. And it's from Jordan Baker. And there's actually two, but I'm just going to do the one right now, Jordan. I'm sorry, I'm still effed up by Full Value saying that gnocchi is spaghetti. It's still bothering me.
What's the matter with that guy? And
Yeah,
they didn't like talking about Italian food. What's the matter with these people?
it's not spaghetti,
Yeah.
first of all. Any comments on the oil crunch going on from 2025 and on, or 2005 and on? And now, to me, an oil crunch is a lack of supply. And maybe I'm interpreting that wrong. So, Jordan, if I am, please correct me. But Goldman Sachs just put out a piece a couple of days ago talking about spare capacity being at the highest quartile in history in Brent. So I don't know, maybe we disagree. Maybe Jordan knows more about it than I do. So Jim, either one of you, but Jim Bianco, what's your opinion on this?
Yeah, let me try and interpret the question, because he said 2005. Did he mean 2025? Maybe there was a typo in there.
Probably 2025, because he corrected himself underneath that. He said 2025 on. He corrected himself in a comment on
Right.
Oh, potential.
So let me go back.
Yeah.
Let me go back to, you talked about the spare capacity. Let me go back to what I said earlier. The German economy is a shit show. The Chinese economy is a shit show. The Japanese economy is struggling. We're going to have too much oil. They're just not consuming enough. The demand out of those three countries is not strong enough to basically sop up spare capacity. That's why the price of oil is struggling. Now you throw in that Trump is drill, baby, drill. He wants to get the U.S. another three. Or Scott Bassett says, we should produce another 3 million barrels of oil a day. The problem we're going to face if we want to try and drill, baby, drill and put in another 3 million barrels a day is we're going to drive the price of oil so low, we're going to put oil producers out of business. And unless the rest of the world, especially the Chinese, 1.4 billion people in China, their economy's got to tick up so people have money in their pockets, so they start consuming more and using more energy. So the problem with oil is everybody looks at the U.S. It's 20% of demand. You got to look at the other rest of the 80% of the world. And I'll come back to what I said earlier. You take the U.S. out and you look at the world ex-U.S. right now, it's not in a good place. The U.S. is in a good place. The rest of the world is definitely not. And that's why you've got such excess supply for oil. Why are we in the top quartile? I know I've seen that statistic too. Again, because Germany is on its ass. China is a mess. They are not consuming oil like we thought they were.
So, okay. So right after the cut today and the hawkish cut, whatever, the dollar screamed higher against pretty much broadly against all currencies too. So, and I know, obviously the fundamental reason for that is we have higher rates here, whatever. It seems like it should attract capital flows. Is there something that is a greater commentary on Donald Trump and perhaps the policies that are going to be implemented first half of 2025? Is it just a function of the fact that somebody smart said this, Europe's a museum, China's a prison, and Japan's an old folks home, leaving us to be the only place to come? Is the contrast, is this all negative interpreted? Or can we say, well, actually, we look pretty good in comparison, so our life might be not bad for the next couple of years? How do you feel about that?
No, I agree. I agree with all of that. I mean, that, you're right. First of all, just to reiterate what you said, the reason the dollar screamed higher today, especially against the EM currencies, it was just wiped out. The Brazilian real was just wiped out today.
Robert. Yeah.
As one of the reasons is, look at the U.S. It's growing. It's got rule of law. It's got the reserve currency, and it's got very high interest rates. Full stop. Why are you wasting your time anywhere else? Especially in emerging markets, all the money should be flowing into the U.S., especially as our rates go up. As far as Trump and everything you said about Europe being a museum, Japan being an old folks home, and China being a prison, those are full stop. Can we end this conversation about will the dollar lose its reserve currency status? The answer is no, it will not lose its reserve currency status until you tell me who's going to replace it. Is it going to be the prison? Is it going to be the museum? Or is it going to be the old folks home? No, neither one of those. Is it going to be Bitcoin? In 20 years, maybe in 20 years, you can't do anything with Bitcoin but hodl it right now. It is not something that you could use as a medium of exchange. So maybe someday it can be, but it ain't going to be right now. So by default, we will remain the reserve currency. So when our interest rates go up and our economy looks good, it's going to suck money into the US. And yes, the idea that Trump is the president is just driving that idea of a strong economy and higher interest rates in the US.
Okay, I think your last statement answered my follow-up, because if you rewinded the tape 3 months ago and we didn't know what was going to be the outcome of the election, you would say from an economic standpoint that this is a far, far better eventuality than could have happened had the other side won. Because I personally thought many of their economic policies were a disaster. Am I wrong?
No, you're absolutely right. This is a far better circumstance. And you saw it, you've seen it in financial markets, you've seen it in consumer confidence surveys showing more optimism. The only place it's not an issue, or the only place where it will change, is in the realm of higher interest rates. But again, I'll come back to what I said. It is that mentality of a speculative market that wants cheap rates, and when they see rates go up, they see that that's a problem. And this mentality that any reason that interest rates go up is bad. No, there are good reasons for interest rates going up, and I think we're having one of those. And I would argue our interest rates are too low right now, and they need to be higher. And that is the mistake I think that we're making. This legacy that the Fed has had, that everything is returning to normal. We're going back to 2% inflation. It's going to be just like 2019. Hell, he probably thinks everybody's going to go back to the office as well. So therefore, we could start cutting rates. That was a mistake. And I think the mistake he made today was trying to justify the policy mistake and leaving the door open for more rate cuts in 2025, when the market is looking at this inflation problem and saying that is clearly a mistake.
So real quick, Jordan asked about peak oil, and I'm just going to throw in, I don't think peak oil's been reached. Doomberg is somebody that we talk to a lot. I subscribe to his Substack. He's been an energy PhD engineer for years. And I know there's some people that say we're at peak oil, but Doomberg calls it a myth, wrote a whole piece about it. And I think it was in 2023 at some time about how peak oil was a myth. So you can believe that if you want. I'm not criticizing you if you believe that. It was August of 2023.
Right.
I'm not a believer in peak oil. Go ahead, Jim.
So I 100% agree with you. The thing about peak oil is two things. One, you can have peak oil field. A particular oil field could peak. You know, the Brent fields in the Northern Atlantic, which where Brent oil comes from, those fields have definitely peaked. And then you could bring on new fracking, bring on new technology like fracking and stuff that could actually, unlock some of the or horizontal drilling that could unlock some of those fields. But is the planet peak oil is what you're asking? The answer is no. The planet is not peak oil. From an ecological or an engineering standpoint, it won't be peak oil. It might be peak oil if we produce too much. Only from an economic standpoint, if you keep the price of oil too low and you drive enough of these oil companies out of business, then you could get a slowdown in oil. But no, we're not going to run out of oil. We're not going to run out of oil anytime soon. Particular fields might run out of oil. I mean, the whole idea of peak oil came from the book Twilight of the Desert, which was about the Ghawar field in Saudi Arabia potentially peaking. It was about one oil field peaking, not the entire planet.
Yeah, and I mean, art targets Doomberg a lot, and I'm not saying I'm not a fan. I'm not saying that he doesn't do good work. He probably does, but he's just not somebody that I pay as much attention to. Anyway, I want to go to an earlier question that we got from Shay Schwartz, which I'm assuming is sort of made up. I hope, because now that I picked on it a little bit, can you imagine a scenario where Trump pushes for Powell's exit? It seems like an inevitable clash considering what is brewing. And before you go into that, I think Trump's already said that he won't do that. I want to let Eric know, because he's posted the question twice, and I'll go to him next.
So a quick word about that. Trump has said he won't fire Powell. It's unclear whether or not Trump has the ability to fire Powell. And let's be clear on, if the Supreme Court ruled he could fire Powell, what exactly he could do. He could demote Powell to being a regular Fed governor and then promote one of the other governors as Federal Reserve chairman. That's all he can do in that regard. He cannot force Powell off the board if he doesn't want to leave. And he cannot take somebody walking off the street in order to become Fed governor until the term is over. Now that I've said that, here's what I think he will do. Powell is very important for Trump to stay as Fed chairman, so he has somebody to blame everything on. He could mean tweet or mean truth at him, call him all kind of nasty and terrible names. Scott Bessent has already told us what's going to happen. And that is, we're going to have a shadow Fed. What is a shadow Fed? Powell's term is up in May of 2026. So 18 months from now. May of 2020. Let me back up 1 second. So it's up in 18 months. Trump thinks very highly of Kevin Warsh. Kevin Warsh used to be a Fed governor. Kevin Warsh was a finalist to be Treasury Secretary. That went to Scott Bessent. He was a finalist to be National Economic Council chairman. That went to Kevin Hassett. So is Trump turning to Kevin Warsh and saying, I got no job for you? Does he have a job for him? And the answer is yes, he does, Fed chairman. But that's 18 months away. So what did Bessent suggest he do? In April or May of this year, nominate him a year ahead of time. Nominate him a year at a time, and maybe even ask the Senate to vote months before Powell's term is over on his nomination. At the minimum, if you nominate him, then he could go on CNBC, he could go on Bloomberg, on Fed days and Fed meetings. Jay Powell, the Fed chairman, said X. The future Fed chairman over here, Kevin, is sitting next to me. Kevin, what do you think? And he could armchair quarterback the hell out of him on everything he says. I agree with him here. I think he's wrong here. I will change this. I will keep that. Will that create all kind of problems in financial markets? Yes. But Trump has a ready-made answer. He'll pull out his phone and he'll start putting out a truth saying it's all Powell's fault. The guy could quit and leave in disgrace anytime he wants, and that would fix the problem. But Powell won't do that because he's going to put on Fed independence. So that's where I think ultimately I see that as being a real potential. I wouldn't give you a 50% chance that he does this. That is, nominates Warsh early, so that he becomes kind of the Fed chairman in waiting to second guess what the current Fed chairman is doing. But I'd give you a 40% chance that could happen. And so that seems to be the path that we're heading down right now when it comes to what he's going to do with Powell. Powell is best as Fed chairman. So Trump could say the market's down. It's Powell's fault. Inflation's up. It's Powell's fault. The economy's stuttering. It's Powell's fault. Powell said something that Warsh disagrees with. It's Powell's fault. It's Powell's fault. It's Powell's fault. And that will be the refrain you'll hear for the first year of the second term of Trump.
So, okay, Powell. Okay, here's my assessment. Powell seems like a hell of a good guy. He seems like one of us. He seems like a guy who really wants to do well. That being said, I think it was an absolute unmitigated disaster what happened for the 6 month following June of 2021. CPI was already rocketed over 5%. The housing market was inarguably on fire. And he's like, you know what? I think we're going to hit the pedal, hit the gas a little bit harder here for the next 6 months. I will never forgive him for that. And I think that his chairmanship has been a disaster because of that. Is that too harsh by me?
I would go a little bit too harsh on that, and I'll go for the following reason. I think, look, if it was up to me, I think Powell deserves to be reappointed. But I'm not Donald Trump. So that's kind of a moot point. You are correct. He made an egregious mistake in 2021 with transitory inflation. Now, that might have been, part of, if you recall, Biden was very slow in renominating Powell. And it might have been political, that he was trying to get the job again by not worrying about the concerns about inflation, and that he was talking about inflation being transitory. If you remember, his first term actually expired and the Senate still didn't vote for him before his term expired. And Senate rules are, if they don't vote in the next guy that's been nominated, the previous guy continues in the post. Well, the next guy and the previous guy were the same guy. But, they held that sword of Damocles in 21, over Powell's head. They didn't vote him in. And I remember writing at the time when he was saying transitory, is this political? Because if Powell comes out and says, no, we have an inflation problem, I think we should raise rates. Fine, you pissed off the Senate, you pissed off the president. We're going to vote you out next week. You're gone. They didn't vote him in and then give him those 4 years. And I think that was the mistake. It was a political mistake. But I'm not going to hold him to the standard of perfection. No one can stay to that standard. So I will give him somewhat of a pass on that period because of those circumstances. I think he's done a good job. I'd reappoint him. But you know what? I also would say this about Powell. It's kind of like, if you're a sports fan, I'm a sports fan. And if you're a Chicago sports fan, you get kind of used to, your manager or your head coach getting fired, because it seems to happen every other week here. Yeah. And I always like to say that's half a decision. So, the coach was fired. Okay, I like the guy. You fired him, but do I think it was a bad choice? No, tell me who's going to replace him. I like Powell. I'd reappoint him. But if you told me Powell's out, Kevin Warsh is in, I'm okay with that. I think that Warsh would be an acceptable substitute for him. But, so that really is kind of the issue when it comes to Powell. Again, I still go back. Remember that in 21, 22, his term expired. The Senate did not vote on him. And the inflation thing was raging, and he was talking about transitory. And the thought was, if he starts talking about inflation before they vote him in, they'll just hold a meeting, or the Senate will convene and vote against him, and he's gone in 5 minutes. So he had to kind of wait until they voted him in, and then it was too late at that point.
Eric Hale asked a question.
Eric, my buddy, my fishing buddy.
Like Eric. What happens when he says JCB, I think he means the BOJ, raises 25 basis points and the carry trade blows up? Which obviously,
yeah, I don't think, I think what happened in August, when we had that freak out in the market in August and the VIX hit 60 for 5 seconds, that was the carry trade unwind. The mistake with the carry trade, or the thing that caused that in August, was not that the BOJ raised interest rates. It was that they surprised everybody. And that's what it was. Can the BOJ raise interest rates? Yes. Let me go back. And let me explain maybe the carry trade for some that don't understand it and what's going on. The BOJ, Japan's economy its nominal growth is finally getting off zero. They have 2% inflation. They have zero growth, but it's looking like they might maybe turn the corner on growth. They've had zero growth on and off for many, many years. But now they've got 2% nominal growth. So where should their interest rates be? Somewhere around 2%. Their 10-year JGB is at 1.0. It's above 1%. It's heading in that direction. The Bank of Japan has started to make noise. Look, with 2% inflation, we need to raise interest rates. That's all appropriate, and that's not a problem. The problem comes in that for years and years, Japanese people have said, if I put my money in a Japanese bank, I get zero. If I'm a hedge fund in Connecticut, I borrow from Goldman Sachs in the United States, I have to pay 5%. But if I borrow from a Japanese bank, I get to borrow for zero. I have to take a currency risk. I can't hedge the movement of the dollar yen if I borrow from a Japanese bank, because if I do that, it costs me 5%. And I'm back to the same 5% number if I borrow in the US. So they've been borrowing in Japan. Japanese investors have been pushing their money overseas, especially Mexico, because the 3-month Mexican bills are yielding around 10% or 9.5% to get those bigger yields. That's fine. That's the yen carry trade. If you're going to raise rates because your economy's at 2% and it's predictable and understood, and we know it's coming, it's not as disruptive. But when Ueda comes in, Ueda's the Bank of Japan governor, he comes in with a meeting and says, man, inflation's a bigger problem than we thought. We might have to raise rates faster than everybody thinks. Holy crap. I'm a hedge fund in Connecticut and I got all these levered positions and you're going to jack up my interest cost and I'm going to take this giant loss on the currency. I got to get out of this position right away. And that creates all of the mess. So as long as it is done in a predictable kind of plotting way, I don't think it's a problem. It becomes a problem when they feel like they have to move outside of what is expected.
Two quick things I want to address. I just want to read Sterling's comment because the comment, there's no real question right here. I think the entire media complex is going to foment a financial market panic in order to deter and hinder Trump. All the accepting of false economic reports is going to come to a full stop. Again, we don't need to address that. I think it's something.
I'll address it. I'll address it in a quick way. You're assuming that financial markets can't see through that. I think that the stock market, I think that investors, if they want to start, what you're implying is they want to start lying about the data and jumping up and down and fomenting that everything is falling apart. We've seen this. We've seen this in the past when people have done this. And financial markets can completely ignore it because they will sort out where they believe is the truth. So go ahead and try it. It won't work. The only way it will work is if financial markets honestly believe that is what's happening. Jimmy, what do you think?
Me?
Yeah, about the idea that financial markets will see through any lies that.
I think that that's probably pretty accurate. I worry about it. I think, nothing's absolute. I think there's a bit of a chance that they could shake the tree because selling begets selling. I was actually kind of hung up on the carry trade too. Back in August, it moved so violently. Didn't you think that any weak hands would have capitulated at that point in time? Why did they not?
Oh, I think they did. And I think what it wound up doing was it put the yen carry trade in stronger hands. That it was August 5th. It was August 5th. The VIX hit 60. The market freaked out and it came back. I think that anybody that was, in a highly levered position, borrowing money from Japan was blown out. They were blown out around that period within a few days. And anybody who was left was a strong-handed player at that point. So in the long run, it actually served a purpose. It got rid of the weakest hands.
That's what I think too. Bobby?
Yeah.
Yeah, there's a question I want to put up, and actually I'm going to tack an extra question on the back of Ma AI, which that's what I'm calling you from now on, because you said you're Italian, so you're Ma AI, like you're yelling to your ma. Why is gold losing today? Sticky or higher inflation isn't supposed to be good for gold. If I could just add one thing to that, gold is an asset when inflation is actually shown to be rising. It's not an inflation hedge. It is an inflation hedge, I should say, when the Fed is not fighting that inflation. So right now, the Fed doesn't see that as a problem. They hiked their inflation target. So that would add some weakness to gold because it shows that the Fed is noticing that inflation may be a little hotter than they think. So that would actually be sort of the combination of things that might have people taking profit in gold. So Jim Bianco, your comment on this question. And then on the back of that, one thing I've said about Bitcoin, we said it when we were doing the rundown today, and I want Jim's comments on this. You mentioned Fartcoin, which is funny.
Yes.
There are a ton of shit coins that nobody, in my view, should be looking at, because that to me is where the digital asset bubble is. It's in all the shit coins, right? It's ridiculous. We just saw how many
meme coins exist in the world? And
thousands, right?
Over 5 million.
Jesus Christ.
Yeah, okay, and I think 90% of them are on the Solana blockchain because it takes about 30 seconds to make one. And 99% of them never ever trade.
Well,
And
maybe that's one
occasionally
of the
you
way
get the
Jim and
hawk
I
to
should
a
monetize our podcast. I'm just kidding. We're not going to do that.
right. I mean, every day thousands of them are being made because people are making them, like the hawk to a girl or fart coin, and they're hoping one of these gets traction. And we're talking about a couple of them that have gotten traction. The fart coin one has gotten traction. It was made in late October, and it came at less than a penny, and it traded over $1 in 7 weeks. And it had a mark, and they minted 1 billion of them, so it had $1 billion market cap at its peak. And so, yeah, there is a lot of that. But and by the way, Bitcoin, it looks like it's going to crack below 100,000 here at any point. It was 107 2 days ago.
All right, so this
Let me
brings my question in, if I could.
Yeah.
So you just said that there's all these, they hope something gets traction. I'm sure they cash out of it right away. If you're investing in a coin because it's funny, you're a moron in my view, but that's a whole nother thing. Fart coin is funny, and I think people are putting $2-3 into it, $200-300 because it's funny.
Too. Yeah.
It's a funny story.
It was Dogecoin was the same thing, and the mistake is, I think, that people invest in it, but you're right. Why would there are people all day long making these meme coins, right? Yeah. And 99.9% of them, they never trade one time. And I mint $1 billion of them, and I keep half of them for myself. And what I'm hoping is I mint something like Fartcoin, and then I wake up one day and go, holy crap, this thing has got a bid. I'll sell all these coins to get like real money as everybody starts to buy this thing. And they all wind up, at the end of the day, blowing up. Now, there's a few exceptions to it. Doge might be an exception to it. Shiba Inu might be an exception to it. But those are really the only two exceptions to the whole thing. But understand the reason that this happens is the ease of making one. If you're on one of these networks, you can make one in 1 or 2 minutes, and that's why it's so easy to do it. But let's talk about gold
real quick, if I could, so that you can just answer both at the same.
Because this is how we started on this.
Yeah, I maintain that. So what I said to Jim earlier today, and he didn't disagree with me, although he might. Bitcoin is an exception. Ethereum might be as well, but I don't know enough about it. But I think Bitcoin is an exception because Bitcoin is approaching its limit, right? And if it isn't somehow blown out of the water by financial regulation or something else, if it sustains, it has no choice but to go higher because it's such a limited amount that we're approaching that limit. That's number one. Number two, Bitcoin has to detach from the NASDAQ correlation. It has to. Because if it doesn't, it's not its own asset. It's just tech guys buy Bitcoin when they're up, tech guys sell Bitcoin when they're down. So what do you think about all of that?
The second part, you're preaching to the choir here. I've been yelling and screaming this, for a long time, that if Bitcoin is going to get to, Michael Saylor's 13 million or whatever number you think, Tom Lee's got 250,000 by the end of next year. What is the basis for those arguments? The basis for those arguments are they are a hedge against the instability in the financial system or inflation or bad things happening somewhere else. Fine. If that's what it is, I'm all in. It has to have a zero correlation to the NASDAQ. Because if it's just, because I run this chart every so often, there is a triple levered NASDAQ, TQQQ, and I run a chart of it overlaid with Bitcoin. It's the same thing. That they go up and down together. They are the same things. If that continues, then I agree that Bitcoin's upside is very limited because at that point, its upside is limited because it is a speculative asset. It is
not what it's supposed to be. Right.
Yeah. It's not what because, I'll go you one other one. I've railed against this idea that, once we break 100,000, there's going to be all this FOMO in the Bitcoin. We've been flirting with 100,000 for 5 or 6 weeks, and there hasn't been any signs of real FOMO. Everybody's got to rush in now that it's above 100,000. I know the Wall Street Journal had a story about it the other day, and they found some guy in Amsterdam that bought $1,000 worth of it. Well, that's not exactly everybody FOMOing into it at this point. But the reason no one's FOMOing into it is they're looking at the S&P's up 29%. The Mag 7 stocks are up 60%. Gold is up 30%. And what I've learned about investors is If you want to jump up and down and say, Jim Bianco, you blew it. Look, here's an investment that's up 120%. Why weren't you in it? Your return to me is, I was in these other investments that were up 30 or 60%. I'm fine. I am not going to lose sleep that I missed out on the 120% investment. That's why there's not going to be FOMO. No one is kicking themselves that shit, I only made 25% in the S&P. I should have been in something that went up more. They don't think that way.
Okay, so we have about 2 minutes left before hitting a hard out. You look at 2025. You already said NVIDIA is kind of the key to the stock market. And I will add my own words and say the Mag 7, it's not going to be a graceful exit of the Mag 7 into other things if that begins to happen. In light of that comment, which I assume you agree with, I saw you nod your head, where do you want to be in 2025?
Yeah, in 2 minutes.
Don't say 3-month bills.
No, I won't say 3-month bills, but let me answer the question this way. What should you expect going forward from here? Forget what the stock market's done up until this moment. From this moment forward, what should you expect? Now, the problem is everybody's kind of gotten fat and happy. Oh, 20%, 30%. And that, if you don't give me an investment option that is going to be a 20% return, you're a failure. How about this? If you look at the valuation in the stock market, valuation, people say, well, you can't time the market with valuation. No, but valuation works with expectations. The higher the valuation goes, the lower the future expectations are. Robert Shiller, Yale University, won the Nobel Prize in economics about a dozen years ago based on his work with the Shiller PE ratio and looking at what was called the CAPE excess yield. And I'll bottom line it for you. From this moment forward, you should expect the stock market to return you 5%, 6% over the next decade or so. Could it return you 20% next year? Sure. But then when you recalculate what should it return you over the previous next 10 years, it might be negative at that point. The market cannot keep going up 20% when the economy keeps going up 3%. It can for a couple of years. It can when it's recovering after a dip, but it cannot keep creating wealth at that level, because otherwise it's going to create inflation and it's going to create dislocations. So what should I do in 25? I would say if you can get 6, 7%, I know that sounds really boring and I know that sounds terrible. You can get 6 or 7% consistently from this moment forward. I think you'd be very behooved to take that. If you want to speculate that there's going to be another 20% gain in the market next year, sure, go ahead and do it. But don't bitch if you lose a third or a half of your money, because that's what you're risking if you wind up doing something like that. If the market was on its ass like it was in 2020 and the valuations were very cheap, at that point, the Shiller PE ratio and everything else says, look, you could expect 10 or 11% over the next several years in the market. And that's largely what you've gotten over the next 5 years. But at this point, given the valuations, I don't think you should be looking at this market like what it's returned over the last couple of years. If it does, then the outlook going forward even more becomes worse. Otherwise, let me give you one kind of last thought for this to tie this in. This has been my argument with my Bitcoin friends. Michael Saylor says Bitcoin's going to go to 13 million, excuse me, but in 20 years. Okay, that's 130x gain. So that means that a $100,000 coin is going to be worth $13 million in 20 years. Okay, what are you going to be able to do with $13 million in 20 years? Most people think, oh, I could buy a Hampton summer home for one coin. And, and I was like, no, how about this? $100,000 today will get you a fully loaded Cybertruck. In 20 years, $13 million, if Bitcoin gets to $13 million, will get you at best a fully loaded Cybertruck, maybe a used Honda. Because in fact, if you listen to Saylor, what he's arguing is hyperinflation. And hyperinflation gets it there. And that Bitcoin will protect you from hyperinflation because traditional assets will fall in value. If the stock market is going to roar 20% and 20% and 20% and new high and new high and new high in this new cycle, we will have more and more inflation is what we'll wind up having. That's why I think ultimately you've got to rein in your expectations and think more like 5, 6, 7%.
All right. He is Jim Bianco of Jim Bianco Research. Tell him where to find you on Twitter at.
Bianco Research,
Bianco
Research
Research.
YouTube channel, Bianco Research Twitter, Jim Bianco on LinkedIn. We don't have an OnlyFans page yet. Do you guys have an OnlyFans page yet?
Of course I do. You guys don't. You guys aren't on my OnlyFans page.
Yeah, exactly.
Hey,
We're working
quick,
on one
guys.
too.
Real quick, guys, thanks for all the comments. I'm sorry I couldn't get to them all. The best way to do it is just follow me on Twitter, Bob_Iaccino. Follow Jim at Jim Iuorio, and ask us the questions before the show starts. Just the easiest way, because I'll have them all loaded by that point. But thanks for all the comments, man. We really appreciate it. Jim, thanks again.
Thank
you. Enjoyed it,
guys. We're watching this too. All the DMs, all the retweets, all the support you give us is humbling. Bobby and I started this to create an independent journalism platform that wasn't influenced by producers and sponsors, and you guys are the most important component of it, and thank you very much. We are humbled. This has been Tradiers, the Trader's Edge.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.